Yes, hello and welcome everyone. This is our second session of UK taxation for business and individuals. Uh, and today's topic and learning outcome two is be able to assess the impact of relevant taxes in given situation. Uh, so indicative contents. All right. In this lecture, we will explore various aspects of related to both businesses and individuals. Focus on will be on understanding key advice requirement in specific tax situation. Considering alternative ways to achieve personal or business outcomes with the different tax consequences and assessing how taxation impact financial decisions. So, we will discuss three key areas of taxation. First one is corporation tax, and stamp taxes and value-added taxes. Okay, so in corporation tax, obviously, scope of corporation tax, taxable total profit, chargeable gains of companies, uh, effect of group corporation structure for corporation tax procedure, use of exemptions and reliefs. Then stamp taxes, scope of stamp taxes, liabilities arising on transfer, use of exemptions and reliefs in deferring and minimizing stamp taxes, and finally, value added tax or VAT. So as we discussed previously, you know that income tax, again, essential income tax, essential aspect of personal finance that affect many of so income tax is the tax you pay on your income, and it's calculated based on how much you earn. So the normal rate of income tax in the UK income tax is divided into different bands. So each with its own tax rates. For example, if you see here, if you earn between 1 and 37,500 pound, you will pay 20% of income tax. But if you earn between 37,500 £1 and 150,000, you will pay 40%. And if you earn over 150, you will pay 45%. Dividends. Uh, dividends are payment made to shareholders by companies out of the profits. So the tax you pay on dividends depends on your income level. If your basic rate taxpayer, you will pay 7.5% tax, and here. So 7.5% tax. Uh, if you are higher rate taxpayer, you will pay 32.5%, and if you are an additional rate taxpayer earning over 150, you will pay 38.1%. Then yes. So there are also certain allowances and bands can affect how much income tax you pay. For example, there is a saving income nil rate band, which means you don't tax pay on the first £1,000. Uh, then or £500 of saving income if you are basic or higher rate taxpayer. There is also dividend nil rate band on £2,000. Additionally, there is something called the personal allowance, which is the amount of income you can earn before you start paying income tax. So for the current year, the personal allowance is £12,500. If your adjusted net income is over £125,000, your personal allowance is reduced to zero. So your resident status also plays a role in how much income tax you pay. So if you spend fewer than 16 days in the UK. If you can see here, fewer than 16 days in the UK, you are automatically not considered a resident. But if you spend 180 days or more uh, in the UK, you are automatically considered a resident. So, lastly, there is a child benefit charge. Uh, Parents earning between 50,000 and 60,000. If you are fall into this income bracket, you will have to pay a tax charge on your child benefits calculated at 1% for every 100% of home income over 50,000 pound. Uh, Income tax is obviously a complex but important aspect of personal finance that affects how much money you take home from your earning and investment. So understanding the different rates, bands, allowances, and charges can help you manage your finance more effectively and plan for your future. Yes, can you see my screen
Yes,
and hear my voice? No issues?
no issues.
Okay. So now we are going to talk about some key aspects of taxation related to cars, vans, uh, saving and property income. So these are important consideration for both individuals and businesses. So firstly, we'll talk about car benefit percentage. This is relevant for employees who receive a company car as part of their job. So the percentage rate depend on the car CO2 emissions. For example, if the cars emit 50 gram per kilometer for less, the benefit percentage of is 16%. If it between 51 and 75 gram per kilometer, the percentage is 19%, and it emits between 76 and 94 uh, per kilometer, it's 22%. So you can see that we discussed in our last lecture as well. So finally, it's 95 gram per kilometers or more. The percentage is 23%. So the percentage is used to calculate the taxable benefits an employees receives for having a company car. Then car fuel benefits. This applies where an employer provided fuel for a company car for private use by the employee. So the basic figure for calculating the benefit is 24,000 £100. The actual benefit is calculated based on the CO emission of the car and the price of fuel. Now, moving on to company van benefit. Similar to company cars, the employees who receive a company van for private use also incur a taxable benefit. So the scale charge for this benefit is 3,430 pound, and the van fuel benefit is 655 pounds. ISA or individual, saving tax. These are tax efficient accounts where individuals can save or invest money without paying income tax or capital gain tax on the returns. The overall investment limit for ISA is 20,000 pound, which means you can, deposit up to the amount across different types of ISA in a, tax year. Property income. Uh, if you earn rental income from residential properties, okay, last time you raised a question about it as well. So basically, if you earn rental income from residential properties, there is a basic rate restrictions that applies to finance costs. So this means that only 75% of finance cost, such as mortgage interest, are deductible from rental income. When calculating, taxable profits, understanding these aspects of taxations can help individuals and businesses make informed decisions about their finances and ensures companies with tax laws and regulations. Uh, Pension scheme limits, approved mileage allowances, cars, capital allowances, rates of allowances. Pension scheme These limits determine how much individual can contribute to their pension schemes while still receiving tax relief. So the annual allowance is £40,000, meaning individuals can contribute up to this amount each year and receive tax relief on their contributions. However, there is also a minimum allowance of 10,000, you know, 10,000 pound, which ensure that individuals with lower incomes can still benefit from tax relief on their pension contributions. There is also an income limit of 150,000 pound, beyond which the annual allowance may be reduced. So it is important that there is a maximum contribution limit for tax relief if you have no earning. In this case, the maximum contribution that qualifies for tax relief is 3,600 pound. Approved mileage allowances up to 10,000 miles 50p and over 10,000 miles 25p. So basically, uh, if this is relevant for individual who use their cars for work purposes and reimbursed for their mileage. So for the first 10,000 miles, the approved mileage allowances is 45 pence per miles, and for mileage over 10,000 miles, it's 25 pence per mile. Capital allowances, rates of allowances. Capital allowances for plant and machinery as well as motor cars. These allowances allows businesses to deduct the cost of these assets from their taxable profits. For plant and machinery, assets in the main pool are eligible for an 18%, okay, allowances. So which asset, while assets in the special rate pool receives a 6% allowances. For motor cars, the allowances depends on their CO emissions. New cars with CO emissions up to 50 gram per kilometer qualifies for 100% allowance, while car with emissions between 50 and 110 grams per kilometer receives an 18% uh, allowances. So car with emissions over 110 grams per kilometer receives a 6% allowance. Uh, so here we will discuss two important aspects of taxations, annual investment allowances and corporation tax, as well as discussed VAT or value added and inheritance taxes. So, annual investment allowances, this is a tax relief that allows businesses to deduct the full value of qualifying expenditures on plant and machinery from their profit before tax. The rate of allowances is 100% here, okay, meaning businesses can deduct the full cost of eligible assets from their taxable profits. So there is an expenditures limit of 100,000 pound, which caps to the total amount of expenditures that qualifies for the relief.
1 million.
Sorry? Yes, sorry, 1 million. Yeah. So, which caps the total amount of expenditures that qualifies of the rest. So, moving on the corporation tax. This is a tax that limited companies pay on their profits. The rate of corporation tax for financial year 2019 is 19%. The same as the previous financial years. So there is also a profit threshold of 150,000 pound. So 1.5 million. Okay. So meaning that companies with profit below the threshold pay tax at the main rate. So while those with profit above it pay tax at higher rates. Now value added tax still is 20%. Okay. So this is consumption tax that added to the price of the most goods and services. The standard rate of VAT is 20%, and businesses must register for VAT if their taxable turn exceeds the registration limit of 85,000 pound. Deregistration limit for VAT in their taxable turnover falls below the designations limit of £83,000. Lastly, inheritance tax rates. This is the tax that paid on the value of the individual's estate when they die. So as well as on certain gifts made during their lifetime, there is a nil rate band on of £325,000, meanings that no inheritance tax is payable on the first £325,000 of an estate value, but any amount above this threshold is taxed at a lifetime rate of 25% or a death rate of 40%. Any questions? Everything is okay, Ganesh?
Yes. Yeah.
Okay. So next, capital gain tax, and national insurance contributions. Have you heard anything, Hinesh? They are reducing NIC number. Is that correct? If I'm not wrong, they're
Yeah.
reducing.
Yeah.
I
John.
think so.
Yeah, he's proposed a reduction,
Okay.
which takes effect from this month.
Or this one. So it is, applicable for all employees as well. I think so. Reducing, it's coming down to 10%, 9 to 10% or something like that.
Yeah, something like that,
Yeah,
depending on
new rates.
and saving.
Do you think that this will make a big difference?
Not necessarily, because there is already a lower limit, no
Yeah,
in national insurance contributions.
yeah.
The,
I think
because,
so. They are planning to increase income tax as well. I'm not sure, but I heard, that,
yeah, yeah, and
obviously,
and they introduced levy
yeah,
charges
yeah,
this time,
levy. So
so that
they have not
already
in,
equates and whatever changes they made in national insurance, they
yes,
already taxed people through the levy, which has caused financial issues and disparity.
yeah. So basically, it's a kind of illusion, or just you can say it's a trick. You know that, you know,
Yeah, elections are coming,
they
so
will, yeah, for election purpose, or they will change the name for a while. They will add with something else like income tax or other levies.
yeah. The main point is national insurance is to be able to assist with key components of the economy to
Yes. Oh,
the
yeah, definitely, definitely.
longevity and care of people, but that's not being achieved. That's the reason for national insurance contribution. If the money doesn't fulfill that objective, then there's something seriously uh, unfair and wrong in the way the system is not working within that infrastructure.
Oh, yeah,
That
definitely,
needs to be
definitely.
addressed more than anything. And then there is so much
Yeah.
manipulation and window dressing within the National Audit Office when it tries to analyse the way funds are spent on national insurance contributions. That needs to be those controls need to be put in place and monitored. But that's something that unfortunately isn't effective at the moment.
Oh, yes. Basically, they are just playing with words. They think people will save up to £900 and £1,000 a year. But I don't think so. This will work like that. As you said, national insurance number is a main,
Mm.
source of income for government to spending, social or other, expenditures
Yeah, yeah, and
like NHS or some other kind of stuff.
yeah, exactly. So if it doesn't help those genuinely making a claim or need assistance,
Yes.
then it means that there's a misappropriation of funding or decision making.
Right. Anyway, so capital gain taxes and national insurance, so these are essential aspect of the tax systems, okay, that individuals and businesses need to understand to manage their finance effectively. Uh, Capital gain tax, this is tax which pay on the profit made from selling certain assets, such as property or investments, at a higher price than they were bought for. So there are different rates of capital gain taxes depending on the type of assets and the individual's income. The lower rate of capital gain tax is 10%, while the higher rate is 20%. Uh, there are different, there is also an annual exempt amount of 12,000 pound, which means the individuals can make a certain amount of profit from selling assets each year without paying capital gain tax. Entrepreneurs reliefs and investors reliefs are special tax reliefs that allows individuals to pay a reduced rate of capital gain tax on qualifying businesses assets up to lifetime limits. The rate of tax for residential property is higher with the lower rate of 18% and higher rate of 28%. Sorry. So, national insurance number, when we talk about national insurance number, obviously there are, different classes. There are payment made by employees and employers to fund state benefits, such as as we were talking about state pensions, healthcare. So the class one employees national insurance rate range from nil from earning below 8,600 and 32 pound per year to 12% for earnings between 8,633 and 50,000 per year, and 2% of earning above 50,000 pound per year, 50,001 pound per year. So for employers, the class A employers NIC rate is 13.18% for earning above 1,632 per year. There is an employment allowance of 3,000 pound to help, to help offset this cost for smaller businesses. Here, for smaller businesses, class 1A national insurance are paid by employees. Employers can certain benefits provided to employees, while class 2 national insurance contribution paid by self-employed individuals. Class 4 national insurance rate for self-employed individuals range from nil for earnings below 8,632 per year to 9% of earning between 8,630 and 33 and 50,000 pound and above per year. Last rates of interests and standard penalties for errors in taxation. So the official rate of interest is 2.50%, and the rate of interest is under paid tax is 3.25%. So while the rate of interest on overpaid tax is 0.50%, standard penalties for error in taxation vary depending on the taxpayer's behavior. So ranging from 15% for careless errors to 100% of deliberate and concealed errors. Uh, Apply taxes to give given situations. So here basically we discuss the calculation of income tax, focusing on its components and tax rates associated with each components. So component of income tax, non-saving, saving, and dividends. Yeah. So non-saving, saving, and dividends. Non-saving income includes earning from employment, self-employment, and rental income. Saving income companies, saving incomes comprises interest from bank account, building societies, and certain investments. Dividends are a payment made to shareholders by companies. When we add up all these components, we get the total income. So this is the sum of income from all sources Then we calculate the net income by subtracting any allowable losses from the total income. Then tax rates for non-saving incomes are, income in the basic rate bands, which range from £1 to 37,500 pound. The tax rate is 20%. Then higher, band rate is 45%. So additional rate band 45%, as we discussed above as well. So here it's an activity, calculate the income tax payable by Joe for the tax year 2020 and 21. So first we need to identify Joe's source of income. He has salary 46,500 pounds, saving income 2,000 pounds. Additionally, Joe paid interest of 3,000. Sorry, dividend income is 6,000 pounds. So during the year, he paid interest of 3,300 pounds, which was for a qualifying purpose. So to calculate Joe's income tax, we need to, break down his income into different components, not non-saving income, saving income, and dividends. So no non-saving income, including includes Joe's salary and any other income that is not from saving or in dividend. So in this case, non-saving income is his salary, which is 46,000, and you know. Here 46,500 pound. And then saving income includes interest from bank accounts or other investment. Joe's saving income is 2,000 pound, which he earned from saving. Then dividend income is 6,000 pound. So total income is equal to salary plus, saving income plus dividend income. So total income 46,500 pound, and then plus 2,000 plus 6,000. So altogether is 54,500 pounds. So to calculate his net income, we subtract any allowable deductions such as the interest he paid from his total income. So allowable deduction net income is 54,500 pounds. So interest paid 300 pounds. So his net income is 54,000 and 200 pounds. So taxable income, we subtract Joe's personal allowance from his net income uh, minus personal allowance tax is equal to taxable income, which is 54,200 pounds. If we deduct this one, so this is his personal account, so taxable income. So we will deduct the personal, allowances, which is 12,500 pound. Taxable income is 33,500 pound. Then saving income, then 600. Altogether is 41,000. 700 pound. So basically, here we need to account for any deductions or allowances, like Joe paid interest 300 pound, which is qualifying expenses that can be deducted from his total income. Additionally, he is entitled to personal allowance, which is 12,500 pound. So this is the amount of income he can earn before paying any income tax. So after deducting the interest paid and the personal allowance from Joe's total income, we arrive at his taxable income, which is 41,700 pounds. This activity help us, understand how to break down an individual's income into different categories and calculate their taxable income. So again is, that working on his figure. So basically, here discussing the calculation of Joe's income tax liability for the tax year 2021. So if you look at here, for the portion of his income tax at basic rate, 20%, which is 33,700 pound. So Joe owes 6,740 pound in income tax. So next, we consider Joe's saving income. He has 500 pound, of saving income tax at 0% rate, resulting is no tax liability. The remaining 1,500 pound saving income is taxed at the basic rate of 20%, resulting in 300 pound for income tax. Moving to his dividend income, he has 2,000 pound taxed at the 0% rate, resulting in no tax liability. Remaining 4,000 pound of dividend income is taxed at the higher rate, which is, as you can see, at 32.5%, resulting in 1,300 pounds of income tax. Adding up all three amounts, Joe's total income tax liability comes to 8,340 pounds. So Joe's employer already deducted, 6,800 pound through pay, uh, you know. So his income payable in the difference between his total income tax liability and the amount already deducted, which is 1,540 pounds. It is worth nothing that Joe is considered a higher rate taxpayer, so he benefits from certain tax bands. Saving income nil rate bands is 500 pound, and his dividend nil rate band uses up the remaining basic rate band of 1,800 pounds. So therefore, band ensures that many taxpayers like Joe do not have any tax liability on their savings and dividend income. So next is analyze tax advantages and disadvantages of different courses of actions. So Donald and Trisha are married couple and have regular income, annual income as follows. Donald's salary is 60,000, Trisha is 18,000, in trust 2,000, dividend 19,000, 9,000 pounds. So considering their income levels, it evident that Donald falls into the higher tax bracket with taxable income of 47,500 pound. After deducting the personal allowances, on the other hand, Trisha taxable income is 16,500 pound after considering her salary. Interest and dividend minus the personal allowances, given the scenario, is it's prudent to explore tax planning strategies. Just give me a second, Hinesh.
Sure.
Yes, sorry, Hinesh.
That's fine.
So, considering the income levels, it's evident the Donald's falls into the higher tax bracket with taxable income of 47,500 pound. After deducting the personal allowances, on the other hand, Teresa taxable income is 16,500 pound after considering her salary, interest, and dividend, minus the personal allowances. So, given this scenario, it's prudent to explore tax planning strategies to optimize their tax liabilities. So, one potential strategy is to transfer some investment income from Donald, the higher rate tax payable, to Teresa, the basic rate tax payable. So, by doing so, they can take advantage of Teresa lower tax rate, potentially reducing their overall tax bills. But it is essential to consider the advantages and disadvantages of such a course of actions. While transferring investment income to Teresa may lead to tax saving due to her lower tax rate, there could be implications such as administrative complexities, potential tax implications on, transfer and changes in investment ownership. Uh, Again, continues in our tax planning discussion for Donald and Teresa. We have encountered a scenario where transferring investment income from Donald to Teresa might not be feasible because Donald's sole income is his salary. However, we can still explore alternative strategies to optimize their tax situations. The introduction of nil rate bands present an opportunity for tax saving. Currently, Teresa's saving income exceeds her nil rate band of £1,000, resulting in taxation at a rate of 20%. She pays £200 in taxes on the excess £1,000 of saving income. To maximize tax efficiency, we can consider transferring £500 of interest income from Teresa, Donald here made by Donald, and there was his saving income nil rate band of 500 that is currently being wasted. Trisha would then save £100 in tax, 520% since the transferred amount falls within Donald's nil rate band. So next we can explore transferring sufficient shares to move £2,000 of dividend income from Trisha to Donald. This allows both Donald and Trisha to utilize their dividend income nil rate bands of up to 2,000 each. By optimizing the allocation of dividend income in his manner, they can potentially reduce their overall tax liabilities. These strategies transfers enables Donalds and Teresa to make the most of their respective nil rate bands, resulting in tax saving without compromising on compliance with tax regulations. It is essential to carefully evaluate the implement such strategies while considering any associated implications and seeking professional advice, obviously if necessary. So individuals like Donald and Teresa can effectively manage their tax liabilities and maximize their financial resources. Assess the statutory obligations imposed in a given situation, including the implication of non-compliance. In understanding our statutory obligations concerning tax filing, it is essential to be aware of the deadline and penalties associated with late submissions for online tax return. The filing due date is typically 30th, 31st of January. Here you can see that in the end of the tax year covered by the return. So if an individuals choose to file a paper return, the deadline is earlier on 31st of December. So, 31st of October following the next year. So penalties for late filing can be significant if a return is submitted more than 3 months after the filing due date. There is an initial penalty of £100. Additionally, if the return is more than 3 months late, there is a daily penalty of £10 up to a maximum of 90 days, as well as penalty of 5% of the tax due while with a minimum of £300. Further delays can result in higher penalties if a return is more than 6 months late, but not more than 12 months. The penalty increases to 5% of the tax due with a minimum of £300. If the return is more than 12 months late, the penalty is even more substantial with a maximum of 70%. 70% of the tax due if the delay is deliberate but not concealed, and 5% of the tax due otherwise with a minimum of £300 each case. For example, if the delay is due to carelessness. So these penalties underscore the importance of adhering to filing deadlines and ensuring timely submission of tax returns. Failure to comply with these obligations, can lead to financial consequences. So again, penalties of errors, carelessness, deliberate error, but no arrangement to conceal, deliberate errors, and arrangement to conceal. So amount of penalties: careless 30%, unprompt disclosure or prompt disclosures 0 to 15%, deliberate not concealed 70% penalties maximum on returns, so 20% to 35%, and then concealed or deliberate 100%, 30 to 50%. Again, penalties for late notifications. So maximum is 30%, then 10%, 20%, 30%. So basically, for careless error is notification, the penalty can be up to 30% of the potential lost revenue, or a PLR, which is the tax that should have been paid but was not. So the maximum penalty in this case can be 10% of the PLR if the error is disclosed unprompt, or 0% it is disclosed after prompting by HMRC. So understanding these penalties is essential for individuals and businesses to ensure timely and accurate notification of tax liabilities. By complying with HMRC requirements, they can avoid costly penalties and maintain good standing with tax authorities. Records must in general be kept until the later of 5 years after 31st January following the tax year concerned, where the taxpayer is in business or has rental income, or 1 year after the 31st January following the tax year otherwise. Payment of tax, basically, where it comes to paying income tax, there is a system in place called payment on account, or POA. So there are advance payment made towards your tax bill, and there's a due twice a year. First, you will make a payment on January 31st during the tax year, and then another one on July 31st, still within the same tax year. Interest and late payment of tax. Late payment of tax uh, can lead to penalties and interest charges, which can add up over time. So penalties for here, late payment taxes: 5% of unpaid tax, 10% of unpaid tax, more than 5 months, but not more than 11 months. So more than 11 months after penalty date, 15% of unpaid taxes. So any final payment of income tax, here you can see that class 4 or capital gain tax as follow, basically plenty. So any final payment of income tax, national insurance contributions, or capital gain tax from the due date, which is January 31st following the tax year, it is important that the penalty date is set to 30 days after the due date for tax payments. This means that if you miss the deadline, penalties and interest charges start occurring shortly afterwards. Yes, can you see my screen, Hinesh, or hear my voice? Any issues? No?
No issues. Very
Okay,
clear.
thank you. So non-compliance with tax regulations can have serious consequences for individuals and businesses. These consequences may include fines, legal actions, or other penalties that could impact the financial statement of the clients. So it is essential to recognize the non-compliance can extend beyond financial implications and may also affect stakeholders such as investors, creditors, employers, and the general public. So assess the effect on taxation of financial decisions made by individuals and businesses. Uh, Unlike employees who have their taxes and national insurance contribution deduction from their monthly salary, businesses owners have to take responsibility for managing their tax affairs. So this means ensuring that you accurately calculate and pay the correct amount of tax on your business profit, along with any required national insurance contribution as well. So one aspect to consider in sector taxes, which are specific taxes that apply to certain industries or sectors. It is very important for businesses to comply with these sectors' tax obligations to avoid potential penalties or legal issues. But on the flip side, there may also be opportunities to minimize tax costs through various strategies and planning. Uh, Corporation tax, corporation tax, also known as business tax, is charged on the profit a company makes. It's quite similar to how individuals pay income tax on their earning, but instead it applies to the profit generated by a business. As soon as a business starts making a profit, it becomes liable to pay corporation tax at the applicable rate. So this means that a portion of the profit earned by the businesses goes towards fulfilling its tax obligations to government. Annual accounting. The annual accounting scheme for VAT, a system designed to simplify VAT reporting and payment for eligible businesses. Firstly, to qualify for annual accounting scheme, businesses taxable turnover must be 1.35 million excluding VAT. If eligible, the businesses can join the scheme, which allows them to submit just one VAT return each year rather than quarterly returns. So, under this scheme, the annual VAT return is due 2 months after the end of the accounting year. However, during the year, businesses are required to make payments of VAT based on their previous year's turnover. These payments are spread out evenly across the year with monthly installments from months 4 to 12, each totaling 1/10 of the previous year's liability. The remaining balance of VAT is then paid with the annual return. There are some advantages or disadvantages. Only one return payment spread evenly throughout most of the year. So disadvantages: monitor supplies to ensure the turnover limit is not exceed. Payment based on previous year's turnover may not reflect current year activities. Cash accounting scheme for value-added tax, a method that simplifies VAT accounting by focusing on cash payments and receipts. There are some advantages and disadvantages as well. So amount on VAT to business cash received, annual taxable turnover must not exceed 135,000 pound excluding VAT to join. So useful where long period of credit given to customers, automatic bad debt reliefs, and then disadvantages less beneficial where long periods of credit received from suppliers. Flat rate scheme for VAT, a method that simplifies VAT calculations for businesses. So uh, its advantages and disadvantages. Uh, Under the flat rate scheme, basically businesses calculate a VAT liability by applying a fixed percentage of their VAT inclusive taxable turnover to join the scheme. A business's annual taxable turnover excluding VAT must not exceed 150,000 pound. Additionally, businesses may also be eligible to use the annual accounting scheme alongside the flat rate scheme. So if a business total turnover exceed 230,000 pound, including VAT, they must leave the flat rate scheme. Again, advantages: simplify administration, can lead to less VAT payable, discount of 1% given in first year of registration. Disadvantage: cannot reclaim VAT on purchases and expenses. Flat rate apply to all turnover, including zero rated and exempt suppliers. More VAT may be payable. Then evaluate how alternative ways of achieving personal and business outcomes may lead to different tax consequences. So basically, first returns and inquiries. Uh, First, we will discuss filing deadlines. A company typically needs to submit its CT or corporation tax return by the filing due dates, which is determined as the later of two dates: 12 months after the end of the accounting period, or 3 months after the receiving a notice requiring the return when it comes to inquiries into a company's tax return. It is very important that companies are required to file their return online, similar to individuals. Late filing of returns can incur penalties, and errors in the return are submitted to the same penalty rules as for individuals. Payment of tax due dates. Uh, Corporation tax and how they apply to different types of companies. Large companies, these are companies with certain criteria, such as high profit or significant assets. Large companies must pay their corporation tax in installments, which means they pay their tax in similar chunks throughout the accounting periods. For other companies have a different payment schedule. They must pay their corporation tax 9 months and 1 day after the end of their accounting period. This is usually the case of smaller businesses. Upper limit. Here we will understand how the upper limit of corporation tax is calculated, especially companies with short accounting period and those under common control. So basically, the upper limit is important concept because it determines certain tax obligations for companies. For short accounting periods, the upper limit is adjusted to reflect the period's duration. This adjustment is done by multiplying the upper limit by the number of months uh, and divided by 12. So additionally, companies has related 51% group companies. Uh, the upper limit is divided by the number of these group companies. This applies to situation where multiple companies are under common control or the part of the same group. So here you can see the examples. A Limited, which has one related 51% of group companies. A Limited prepares accounting for a 9 months period ending on March 31st, 2016. To calculate the upper limit for the period, we take 9/12 of the standard upper limit of 150,000, 1.5 millions divided by 2. Uh, as there is one related 51% group company, so the upper limit for A Limited for the period is 562,500 pounds. Research and development. Well, to qualify for research and development reliefs, SMEs must meet certain criteria. They should have fewer than 500 employees. Their annual turnover should be less than 100 million. Their balance sheet total should be under 86 million pounds. For SME investing in research and development, the relief offers significant benefits. It allows them to claim the generous tax relief of 230% on qualifying research and development, research and development expenditure. So this include various expenses such as staff cost, consumable or transferable materials, computer software, and even expenditures on power, water, and fuel directly related to research and development activities. Uh, IR 35 a tax legislations that aim to basically determine whether a worker is generally self-employed or should be considered an employee for tax purposes. Uh, Here, employer salary plus employees national insurance client payment, no national insurance, intermediary companies, dividends, workers. So basically, IR 35 is a designed to prevent workers for using intermediary companies to avoid paying the appropriate taxes that would be due if they were considered employees. So it ensures that tax obligations are met fairly and consistently across different types of working arrangements. Returns and inquiries. Uh, typically this must be done, that here we discuss the requirements and obligations related to filing corporation tax, as well as the procedures involved in case of inquiries and potential errors. So, company needs to file its corporation tax returns. Typically, this must be done by the filing due date, which is determined as the later of two options, either 12 months after the end of the period of accounts or 3 months after receiving a notice requiring the return. When it comes to errors in the returns, the penalties are similar to those for individuals, as we discussed above. If a inquiry into the additionally, if a inquiry into the return is necessary, the notice of to inquiries must be given within 12 months after the later letter of the actual filing date. Later of the actual filing date or specific dates in January, April, July, or October following the filing due date. Basic period rules. When a business starts operating, we use what's called opening years rules to assess its tax obligations. So this means we consider the business profits from the starts of its operations until the end of the tax years. For businesses that continue operating years after years, we assess their taxable profits based on the 12 months accounting periods that ends within the tax years. So this helps ensures a consistent and fair assessment of their financial activities. Opening year rules, first tax years, which is the year when the businesses begins trading. We assess the profits from the date it starts trading until the following 5th of April. Okay, so this period marks the end of the tax year in the UK. So second year, see flow chart. Yeah, here. So year rules, basically second years, when we talk about second year, uh, things becomes a more detailed. We follow a flow chart to determine how to assess the business's profit. This flow charts helps a negative through different scenarios based on business's activities and changes in its operations by understanding these opening years rules. So businesses can ensure they are accurately reporting their profits to tax authorities and complying with tax regulations from the very beginning to their journey. So it is essential for new businesses to grasp these rules to manage their tax responsibilities effectively. So opening year rules assess 12 months on accounting date in third years, usually, CYB. Uh, Third year assess the profit for 12 months ending on the accounting dates in the year. So the assessment typically following the current year, usually current year basis. So, but if long period, last 12 months of the that long period, so overlap profit, these are profit that may be taxed twice due to the way profits are assessed during the opening years and closing years rules. So basically, understanding these rules helps businesses navigate their tax obligations accurately, ensuring they pay the correct amount of tax and receive relief for their overlap profit when they cease trading. It is essential to manage these aspects effectively to avoid any tax discrepancies. Taxable total profit. Uh, taxable total profit, uh, the taxable total profit, we first gather all the income and gains from various sources that the company has earned throughout the tax year. This includes profit from its traders, interest from non-trading sources, any other profits, income from its property, business, and chargeable gains from the sales of assets. So when we has aggregate these sources of income and gains, we calculate the total profit by adding them all together. So next is taxable total profit continuously. Uh, Interest income, and property business income in the context of calculating taxable total profit. Interest income from non-trading sources refers to the money a company earns from investments or loans, like interest from saving accounts or bonds. This income is included in the calculation of taxable total profit. We must subtract any interest payable on loans that are not related to the company's trading activities. For example, if the companies took out a loan to buy rental properties or invest in subsidiary companies, the interest payable on these loans would be deducted from the interest income. Accounting periods, when a company accounting period is longer than 12 months, it needs to be split into two separate accounting periods. The first 12 months from the one accounting period, while the remaining months from another. For example, uh, if if a company A Limited, here A Limited prepare accounts for a period of 15 months ending on 31st December 2016. It would have one accounting period covering the first 12 months until 30th of September 16 and a second accounting period covering the remaining 3 months until 31st December 2016. Computing corporation tax payables, rates of corporation tax are set for financial years. The financial years run from 1st April uh, is 1 year to 3rd March on the next year financial years. 2016 runs from 1st April 16 to 31st March 2017. So basically, uh, understanding the rate of corporation tax is important for businesses to accurately, calculate their tax liabilities and fulfill their obligations to the government. So basic again, basic periods of each tax year is normally the period of accounting ending is that year. So sole trader makes up accounting 31st December each year. The basic period of 16-17 will be the year to 31st December 16. When it comes to tax, the period of account that ends in a specific tax year is called the basis period for the tax year. So here you can see examples. Since your accounting period ends up on 31st December 16, the basis period of the tax year 16-17 will be the year up to 31st December 2016. The basis period for tax is the same as your accounting period. It helps the determine which profit or losses are taxable for a particular tax year. So any income you earn or expenses you incur during the basis period will be considered for taxations in the corresponding tax year. Opening years in the first year of operations known as year opening year, the basis period start from the date that businesses commence trading or start tradings and ends on the 5th of April following the date. So this is because the UK tax uh, year runs from the 6th of April to the 5th of April the following years. Overlap profit again, uh, overall picture of something that we need to understand. There are profit that might end up being taxed twice because of the way the accounting periods are structures. So overlap profits can become important when the businesses comes to an end in the final year of the businesses, and any overlap profit are deducted from the total profit. This helps to avoid the situations where profit are being taxed twice, which wouldn't be fair to the businesses. Final year, uh, we calculate the final trading profit assessed for ninth sorry, for what's name Nitin. So who has been in businesses for several years. Nitin prepares his account annually with his financial year ending on 30 June each year. So first we need to identify that the final years of Nitin's trade is 16-17. Because he ceased trading in 30 September 2016, so the basis period for the previous year 15-16 would have ended on 30th of June 2015. So the basis period for 16-17 starts on 1st of July 15. So now we have to calculate Nitin's final trading profit assessment for 16 and 17. We add up the profit for the year ending 30th June 2016, which were £70,000, and the profit for the 3 months ending 30th separate September 16, which were £15,000. So, however, we must remember the deduct any overlap profit. In Nathan case, there were overlap profit of £9,000 when he starts trading. So the assessment for Nathan's final years of trading 16-17 is the total of his profit for give us a final figure of £76,000. This calculation ensures the Nathan's final trading profit is accurately assessed, considering any overlap profit he may have had from previous years. Change of accounting dates. When there is a change in the accounting date, the tax year with the new accounting date is considered the year of change. So what happens year before the change? The taxable profit are calculated from the beginning of the year up to the old accounting date. So year of change, we need to deal with the gap between the old and new accounting dates. If the gap is less than 12 months, we create a new overlap from the year before. So year after the change, taxable profit are calculated from the beginning of the tax year up to the new accounting dates. So if the gap between the old and new accounting date is more than 12 months, any overlap profits from the year before the change are relieved. So the process ensures that any overlap profits from the old accounting periods are appropriately managed when transactions to a new accounting period. So here are some references or for further reading. You can visit ACCA, global website. Yeah, that's it for today, Hinesh. And if anyone is there, so if there is any questions, concern, issues, you can drop me an email at yasir@ukversity.co.uk.
Yes.
That's it for today, Hinesh. Any questions or any concerns?
Yeah. Can you just hold on slide 10? I just missed that.
Which one is it?
Slide number 10.
Slide number
Number 10. Slide 10.
yeah, I'm looking for it.
Yeah, you just gone past it.
Yeah, activity.
That's it.
No, I did not pause that.
No, I missed it.
Oh, you missed it. Okay.
Yeah.
So basically, you want me to repeat this one?
No, it's fine. It's fine.
Okay.
I can see from that example and then refer to page 11.
Yeah, basically, it's a Joe calculation of Joe's sources of income. He has a salary of 46,500 pounds. Saving income is 2, and dividend income of 6,000 pounds. So additionally, he says that Joe paid interest of 300 pounds, which qualifies for a deduction. So basically, to calculate Joe's income tax, we need to break down his income into different components like non-saving income, saving income, and dividends. So non-saving income includes Joe's salary and any other income that is not from saving or dividends. In this case, Joe's non-saving income is his salary, which is 46,500 pound. Okay, so here is a further calculation.
Yeah.
Okay.
Makes sense. Thank
Yeah,
you.
thank you very much, Inesh, and I'll see you next Sunday at 11:30, hopefully.
Yes.
So thank you very much, and bye for now.
Bye for now. Have a good weekend.
Bye.
Take
You
care.
too. Bye.
Bye-bye.